questions on where we're headed? I also think we have a time change coming up this weekend. So I think the time change for us that are in the morning students, I think that'll be a positive one. I think you guys get an extra hour. We were discussing that earlier. I don't know about you guys, but it's harder and harder to get up early when it's dark outside. So hopefully that will help. Okay. If you don't have any questions, then our big goal for today is the cash budget. And so the last page of your handout, this is the same handout that we looked at last time, but towards the bottom, is what our focus is going to be on today. So we're working on cash budgets. And if you remember a picture that we drew, it's kind of a step down approach. Let me get a new document in here so I can just jot that master budget down. Sorry, I have some other files open on another screen. That's why I'm looking off to the side. Give me 1 second. Blank document and bring it over to your screen. Last time we were here, we talked about this master budgeting process. And we said the whole thing begins with this sales budget. That's the starting point. And that sales budget, kind of to recap where we've been, showed the number of units that we were going to sell and also the dollars that we would bring in. And the way you compute the dollars is just by taking the number of units times the selling price. But that was our starting budget. In practice, that budget is usually one of the more difficult ones to do because it involves projecting out, it involves supply and demand, it involves what our competition's doing. But in this chapter, the sales numbers will always be given to you. And then the next drop down one that we did was the production budget. And it was the only budget that had no dollars associated with it. So we were after just the number of units to be produced. And we said on that one that if there were no inventory issues, the sales and the production budget would match as far as the number of units. So what we said on this one is we start off with the sales numbers and we added in the desired ending inventory and we took out the beginning inventory. And that gave us the number of units to be produced. Okay, and we worked on both those last time. And then we said the production budget is the starting point for the 3 product costs, which we all know: direct materials, direct labor, and factory overhead. We worked on those last time. And we also said that it's also the starting point for the period costs, the general and the selling costs. And then there might be other specific budgets out here, like a capital expenditures budget. That means like big pieces of equipment. In other words, personally for us, it would mean if we plan on buying a car next year, that would be an example of a capital expenditure, something that we need to plan in advance for. And at the end of all these is what we're working on today. It's the cash budget. So all those budgets feed this cash budget, which answers the question, am I going to have enough money to fund all these other various plans? Remember that budgeting is an important measure in the planning, directing, controlling feature of what managers do. So the planning, it helps us look forward. And if I know as a company that I'm going to be short on payroll, I want to know that months ahead of time, not the night before when I'm going to be stressed out trying to pay in a previous company that I no longer own. I have an interest in it. I had 83 people that needed to be paid. If I would have found out the night before that I couldn't pay those 83 people, we're talking about 83 families that would have been left in a lurch. I would never do that. And so it was important to me to project that out so that I could go to the bank and get funding for the short periods, the times that I was going to be a little bit short. And so that's the reason that we do these cash budgets ahead of time, because we want to plan out any shortages. We want to have a plan of attack to meet those needs. Your book most often will talk about a line of credit. So I want to make sure that that word is in your vocabulary. So one of the reasons that we do a cash budget is so that we can have a backup plan on months where we fall short. And one of the things that I use both professionally as well as personally is a line of credit. So most often I'll talk in personal terms because many of you may have parents that have one, you might be able to relate to it. For personal terms, a line of credit is when I walk into my bank, I use Bank of America, but doesn't matter what bank. I walk into Bank of America and say, you know what, I need a line of credit, and they'll see what kind of assets you have. And most often people will get a line of credit against a house or a building that they own. And so what that means is, okay, Bank of America says, okay, we'll allow you to borrow up to $300,000. They leave it as a line. That doesn't mean they give me a check for $300,000. They say you have open to you a line of credit where if you need to draw from that, you can draw up to $300,000. I just pulled that number out of the air. And if you take money out of that line of credit, you're responsible for paying interest every month for a draw period. For personal loans, it's usually about 10 years. And when that draw period is over, then you need to start paying us back the principal and interest. So why am I telling you about this line of credit? Because in these problems, you're going to come across companies that have what they call an open line of credit, where they will be required to make interest payments each month that they hold that line of credit. And on the problems we'll be doing today, you'll also see, and I want to get this word into your vocabulary, debt covenants. These are related. So I had never heard that word in college, I think until I got into my finance class. And the word covenant I had heard of. The word covenant means a promise. So a debt covenant is a promise that you make when you take out that line of credit or when you take out the debt. You make a promise to the bank that at all times I will keep X in my account, whatever X is. So for example, there might be a debt covenant or a debt promise in my note or my line of credit that said, at all times I will keep $30,000 in my cash account, right? That's a debt covenant. That's a promise that you're making to the bank that you promise to always have $30,000 in your cash account. So that if you don't, right, property taxes are due in 2 more days, November 1st. Lots of people are not going to have money to pay their property taxes. Even when I pay my property taxes, I guarantee that there will be $30,000 in that account. So if there's a big charge like a property tax bill coming up, you borrow from the line of credit to meet that debt covenant. And you're going to see that in some of the cash budgets that we do today. So those were 2 words that I definitely wanted to get into your notes. So again, this cash budget has the drop down of all the other budgets. Now we're going to be answering the question, do we have enough cash to fund our operations? And if the answer is no, we need to draw from a financing source, often a line of credit, so that we can keep that debt covenant, keep that debt promise, and always have our cash at whatever amount we promised our bank it would be there for. The rest of the cash budget, honestly, if you think about your own personal checking account or your own personal savings account, the cash budget really works like our typical checking or savings account. Okay, what do I mean by that? Let me get another piece of paper up here. I think I had it in your handout, but just in case I didn't, here's what my cash account looks like, personal wise, and it works the same business wise. So I'm going to have my beginning cash, right? So whatever my cash was, I don't know why that's gray like that. Whatever my cash balance was at the beginning of the month. So we're in the month of October right now. Whatever my beginning cash was on 10/1 would be my starting point. Now, I don't know about you guys, but in my personal cash account, I might have 1 or 2 checks come in. Most of us work or we have some type of income. So for me, you add in the cash receipts. In my case, and probably in your case, that would be deposits in your personal account from work. So that says cash receipts, CR. And you take out your cash disbursements. Those would be the checks, the payments, the ATM, anything else. And if I would project those out, remember when we do budgets, they mean ahead of time. So if I were to project that out, I would start off with the beginning cash. I'd add in my cash receipts. I'd take out my cash disbursements, and that would be my projected ending cash. I think most of us can relate that to our regular accounts. With my Bank of America account, I might have 1 or 2 deposits. I have a bunch of different little payments for groceries and utility bills and all that other stuff, donations, all that stuff. I can project out my ending cash. And here's probably the part that is new to you, because most of us don't, at your age, probably don't have debt covenants. You want to compare this to any kind of debt covenant. What does that mean? It means if I've made a promise to my bank to have $30,000 at all times, and this has fallen below, then I need to pull from the line of credit. Excuse me. And one of 2 things can happen. You might need more dollars from the line, which means you're going to add to the line, or you may have, which is what I try to do when I have extra money. In other words, if this number is above my debt covenant, you may make a payoff against the line, or not a payoff, but a payment against the line. And that will get you down to your ending cash, right? So let me give you an example of that. If I have lots of cash, maybe it's around Christmas time and I'm selling a lot of stuff in my business, and my cash is 40,000, and I've promised my bank that I will have 30,000 in there. That means I have an extra 10,000. I could keep it in there, or I could say, you know what? I got this, I'm flush this month. I got extra cash. I'm going to use that extra 10,000 and pay down my credit line. And so many times businesses will take anything above the minimum requirement and pay their debt down to keep their interest costs down. And that, in a nutshell, is what we're going to be working with today. Couple new words for you: debt covenant, credit lines, couple new concepts in there. But pretty much the way that I remember this cash budget is just to think about my own personal account. Add in the receipts, take out the payments. That would be a way to project out my ending cash, right? In other words, just again, 20,000 foot level, trying to keep the big picture in perspective. If I asked you, project out your December cash, right? Most of us could probably, if we track our spending, most of us could probably do a pretty good job of what we think our ending December cash balance would be. We would take our beginning cash balance on 12/1. We would add in whatever our normal paychecks goes into the bank. We could estimate that. We have hopefully some type of a budget where we could list the checks, the payments that we make for our every ordinary day expenses. Maybe some of us spend a little bit more at Christmas time, so we would include that. We would get a projected ending cash balance. If we find out, oh my gosh, it's below the 30,000, I need 30,000, I made a debt covenant, I promised my bank I keep 30,000, then we'll be drawing from that line of credit to bring it up. If we instead find out, hey, we're flush, which doesn't happen around Christmas time, but hey, we're flush with cash, we may decide, okay, since I'm flush with cash, I'm going to make a payment against that line. And that's what you're going to see happening today in the homeworks. So that's kind of an overview as to where we're headed. Do you guys have any questions before we jump in and get our hands dirty? Okay, if you guys have any audio issues, the chat room is available. I know some people are having video issues and audio issues, so Juan's going to keep his eye on the chat room. Juan mentioned that he was having a video issue today, so we won't see his smiling face, but he is there and he's available to answer questions. Okay, so let's jump in and do our first attack on a cash budget. So what I'm looking at are the Excel files that hopefully you've downloaded by now. And this is for day 2. And we're going to jump in and do our first cash budget. This one's fairly straightforward because they've given us the cash receipts and cash payments. We'll learn later today how to do the schedules that support these cash receipts and cash payments. So if there are no questions, I don't see anything in the chat room, we'll go ahead and start it. So Kayak Company budgeted the following cash receipts, excluding cash receipts from loans. That means excluding the draws that they're taking against a credit line, and cash payments, excluding loan principal and interest, for the first 3 months of the year. So here's basically, this is a listing of their cash receipts. This is a listing of their cash payments. What they're letting you know is these cash receipts don't include any loan proceeds because we don't know if we're going to need to borrow it or not. And these cash payments don't include any interest payments because we don't know how much we're going to need to borrow. According to a credit agreement with the bank, Kayak requires a minimum cash balance. So there's that debt covenant. That's important. We can't let our cash fall below $30,000 because we've made a promise to our bank that in order to get this special rate or in order to get this special line of credit rate, we promise that we're going to keep $30,000 in our account at the end of each month. So one of the purposes of our cash budget is to make sure that our balance doesn't fall beneath that. If it does, the problem is going to tell us that we're going to go draw on a credit line. Okay, in return, the bank has agreed that the company can borrow up to $150,000. Okay, there's the credit line. You might want to write in there, that is a credit line. They've given them a line of credit of $150,000 at a monthly interest rate of 1%. Okay, which is kind of odd that they give you a monthly rate. Usually they would say 12% annually, but they gave us a monthly rate, probably giving us a break on one of the first cash problems. Paid on the last day of each month. Okay, so what did they just say? If we need money to get us up to the $30,000, we can draw from our credit line and pay interest only at 1%. The interest is computed based on the beginning balance of the loan for the month. The company repays loan principal with anything above that minimum. So here's what they say. If we have more than $30,000, we're going to pay that loan back. And if we have less than $30,000, we're going to pull from the line to get us up there. That's kind of a good definition of a covenant there. The company has a cash balance of $30,000 and a loan balance of $60,000 on January 1st. Okay, so first thing we would do is head this up properly. In the interest of time and space, I'm not going to mess with that, but here's what it would say. It would say Kayak Company, second line, cash budget. And this would say for the quarter ended March 31st, because they're giving us January, February, and March. And it's going to look almost like that chicken scratching that we did earlier. So let me move my other thing up. This is what it's going to look like. I'm going to chicken scratch this out. I'm going to leave myself a line to write in the months. So I'm going to leave one line blank. And then I'm going to start off with my beginning cash balance. And then just like we would do in our own personal accounts, we would add in our, I'm going to call that projected cash receipts. And we would take out our projected cash payments. And that's going to give us, well, you know what else I can put in here right now? Because I know that we have a loan. So I'm going to go ahead and put interest payment. Because I know we have a loan. It mentioned that we had a $60,000 loan balance. So we'll get that out of the way. And that's going to give us our preliminary cash balance. In other words, I'm going to compare that to the $30,000 debt covenant. I've promised to keep $30,000 in there. If I have more than $30,000 here, I'm going to start paying that $60,000 loan down. Okay, here's our loan. If I have less than $30,000, I'm going to have to pull from that line of credit, which is going to increase the loan balance. Why? Because I gave the bank my word that I would keep $30,000 in my account at all times. And then across the top is going to go the months. So January, February, and March. So let me stop. We will have something happen down here. I guess I could put it in. So two things are going to happen. I'm going to need to do additional draws on the loan, right? So if I take money from my credit line, the word for that is called you're drawing on your credit line. You're taking money from your credit line and you're putting it into your bank account. Or, so I'm going to put a slash there. Oops. Excel doesn't like me to start off with a formula like that. I'm going to put a little apostrophe in front of it so it doesn't think I'm putting in a formula. So it'll either be a draw on a loan or it will be a payment if we have extra funds. And I'm going to put that same apostrophe in front of it or it thinks I'm starting a formula. So less payments on loan. That's all going to depend on this line item. When we do January, if it's above 30, we'll pay the loan back, start to pay the loan back. If it's below 30, we're going to have to draw some more money and increase our cash account because we made that promise. And once we're all done with that, that's going to be our ending loan balance. I think this will seem more simpler to you after we try one. Right now, it might seem like, whoa, that's a lot of words. Here's all it is. It's what you would have done had I asked you to project your December cash. You would have started off with the balance that you think you'll have. You would have added in cash receipts. You'll take out the payments. You'll pay that interest just like on our car loans. We've promised to pay interest. And that's going to give us this number. So let me go ahead and put an equal sign there. So you see that the first part of this is pretty easy to get to our preliminary cash balance. The only reason this last part is necessary is because of that $30,000 debt covenant. We promised our bank that we would keep $30,000 in our account. And so that's why we need this. And really, to make this easier for you, if we weren't just starting the cash topic, I would have put something easy like plus or minus line of credit. And I'd increase it if I needed to draw, and I'd decrease it if I was making a payment. So let's jump in and start one of these. I think once we do one or two, it's going to become self-explanatory. So before I jump in with these numbers, anybody have any questions? Just unmute yourself. Okay, then let's jump in. My starting cash balance was $30,000. It comes from right here. The company has a cash balance of $30,000. So that's going to be my starting point. That was January 1st. So I'll put that in. And to make these numbers look a little cleaner, I'm going to hit the select all button up here. And I'm going to go choose the comma format. You can see what it did. And I don't think we need decimal places. So to save space, I'm going to get rid of those 2 decimal places. So I'm just trying to clean up our numbers. Okay, and then the cash receipts, I'm just going to go copy those down. So these cash receipts are going to fill this line. In other words, they gave us the cash receipts. I'm just going to pop them in there going across. So 525,000 was January, 400,000 was February, and March was 450,000. There would have to be a schedule supporting that. We'll get into that schedule later today. And then my cash payment, so that I don't mess this up, I'm going to put my cash payments with minus signs in front of them. That makes the calculations for balances a whole lot easier. So I'm going to carry those across. 475. Again, I'm going to put a minus sign in front of it to help with the visual and the math. A minus 350,000. And then we see in the last month that the cash requirement goes way up as far as payments. So let me stop. See if you have any questions. And then now I'm ready to run the numbers. So my preliminary cash balance for the end of January, I'm just going to foot this down. So I'm going to sum up from the top to the bottom, or you guys can use your calculators. No, one thing I did forget, I forgot this interest payment. So let me go get rid of that. Forgot this interest payment. Remember what they told us it was going to be. In fact, I'm going to write it in. They said it was going to be 1% monthly, 1%. So before I sum that up, let me go get the payment on that loan. Now, what they told me is that the payment had, or the loan balance was $60,000. And so I'm going to go ahead and do a calculation. And so to show my calculation, I think I'm going to bring this line down 1. You can slip it in there. So here's my calculation for that first payment. The loan balance is $60,000. They just mentioned that. And the interest rate was 1% per month. So right now, for the first month, I have a $600 interest payment, because 60,000 times 1% is 600. And because that's cash coming out, I'm going to put a minus sign in front of that. Okay, now I can do, any questions? Now I can do my preliminary balance. I got 79,400. Now, do you guys remember what the debt covenant said we had to have? It said we needed to have 30,000. And so what that company's going to do with those excess funds, anything above 30,000, they're going to pay that loan balance down. So this should have said ending cash balance here. Just saw that typo. They're going to pay that loan balance down. So someplace at the bottom, write yourself a note. I don't care where it is, someplace off to the side. Right now, the January loan balance, we know, is 60,000. So what they said is, if we have above our minimum balance, we're going to use any excess to pay that $60,000 down. So am I above 30,000? The answer is yes. By how much? By 49,400. I'm going to pay that extra money against this $60,000 loan balance. So I'm going to take 49,400 out of my account, pay down my loan. And so what is my loan balance now? Well, I just paid 49,400 against that 60,000. Let me do that on my calculator. 60,000 minus 49,400. I got 10,600. And I'm going to label that is now the 2-1 loan balance. And since that's a payment, I would do this on one line. The only reason I didn't put it on one line is because it would push my other Excel work way off to the right. This is really one line here. So in this case, I'm making a payment. My ending cash balance then is the 30,000 that I'm required to have in my account, taking the difference between these two. There's my ending cash balance. And somebody might say, well, wait a second, what happened to that money? We had a lot of extra money. And so to keep interest costs down, what the direction said is we're going to draw down the loan. We're going to pay down the loan. So it was 60,000. We took 49,400 out of our cash account, sent it to the bank saying, I don't owe you that much anymore. Here's the new balance. And while I'm at it, now we know how much interest expense will incur for the next month. So I'm going to go up here and I'm going to put that new interest amount in. I might as well fill it in while I'm talking about the interest. So now my loan balance is 10,600 times 1%. And so I can go ahead and put that loan payment in there. And then it's just going to be a matter of me running the numbers. I have all the numbers I need now. I'm going to run the numbers on this. So any questions on the first month? Let me scroll up so you can see. Any questions on January before we run the numbers? Or any questions on where any of those numbers came from? Maybe you need a little bit more explanation, or I went through something too fast, or you're not sure on how a certain number was derived.
I have a question.
Sure.
Where did the 49,400 come from?
So where that came from is our preliminary cash balance is 79,400. I think that was Davi's voice. Davi, do you understand where the 79.4 came from?
Yes.
Okay. So then what we're going to do with that is anything that is above our $30,000 threshold that the bank says you must have in your account, we're going to use the extra proceeds to pay down the loan. So where that number came from is the difference between what we have and 30,000. I have to have 30,000. So the rest of it I'm going to use to pay back that loan. Is that clear? Or you still don't?
Thank you.
Yeah. Anybody else? Okay, well, just like on our accounts, the ending balance of January, this 30,000 here, becomes the starting balance for February. So now I just run the numbers. I started with 30,000. I have projected receipts of 400. I have projected payments of 350. I had that interest payment that I have to pay back based on the loan balance at the start of the month. So now I'm getting ready to foot this. Let's go ahead and foot it. I'm going to use Excel. You guys can do the same, or you can use your calculators. So right now I got 79,894. Okay, well, this is good news. We are above that $30,000 debt covenant. So we're going to use any excess to pay off our loan balance. Okay, well, let's go look at our loan balance. Our loan balance is only 10,600. So I'm going to go pay that off right here, and I'll still have some flush money in my account. I would never pay the bank more than I owe them. That would be crazy if I did that. So some people on your homework are going to make the mistake of taking 30,000 away from this, like we did over here. And the reason that would not be correct is because we would never pay more than what we owe. So I'm getting ready now that I'm above 30,000. I'm going to go pay off that $10,600 loan. I'm going to put a note on what that is. Pay off loan. And now I'm ready to run the numbers again. But let me tell you this, I can come over here, and since I have no loan, I have no interest. I'm going to come over here and put none. No interest for the next month because my loan balance is now 0. So let me foot this, see what my ending cash balance is. And what I'm doing here is taking the number I already derived, 79,894, and take out the 10,600. So here I go. And here's my new cash balance. I don't have a loan to pay off. I've already taken care of that. So you know what we're going to do with that number? We're going to go run the last line, the last column. So before I do that, any questions on January or February? Okay, then let's run it again. My ending balance from February will be my starting balance for March, 69,294. I have a $450,000 cash receipt. And here's an uh-oh. It's never good. You guys have probably had experience with this at home. It's never good when you have more going out than what you have coming in. Okay, but we had a little padding there. So we are ready to run the numbers. I'm feeling an uh-oh come into play because, again, as an accountant, I never like, and this is what's happening in November with property taxes for a homeowner. November is a month where I have more going out than I have coming in because of those crazy California property taxes. That's why you need to build those accounts up. So let's go ahead and run the numbers. And that's an uh-oh, right? It's like, what do you mean we have negative cash? This is why we do budgets ahead of time so that we can plan or make up for any shortfalls. So I have a negative projected cash balance. Can't have that. I signed a loan, a debt covenant that we talked about at the start of class that promised that at all times I would keep $30,000 in there. So to keep that debt covenant, I'm going to have to draw on my loan. Okay, but how much? How much do I need to draw on my loan? Let me bring this down to the line it should be on there. How much? Now be careful because some of you are going to say, oh, well, you need to get up to 30. You need to take out 25,000. Okay, but that's not right. If I took out 25, if I drew 25 from my line and stuck it in my cash account, I'd only be up to 20, right? I need this number to be 30,000. So how much do I need to draw against that line? 35,706 to make that bottom number 30,000. I need to take out from my loan or add to my loan 35,706. What's that going to mean? That next month I'm going to have a big interest payment because I'm having to grab from that line of credit that right now is at 0 and bring it up so that when I do this balance here, when I foot this, I better have that $30,000 debt covenant. By the way, some of the penalties for not meeting that debt covenant, we described that at the start of class. They can call your loan due all at once, and nobody wants that to happen. So when I foot this, you're going to see that that does bring my balance up to 30,000. Let me do the equal sum so you can see that when I sum that up, I now have the required $30,000 line. Why is that line of credit so important? For months like this, where you have a big oops, on months like this, like in California right now, with everybody having to pay property taxes the 1st of November, right around the 1st of November, you got to have a way, some type of an emergency fund to continue the household to keep going. And one of the ways you can do that is with a line of credit. Now, they didn't ask us to do March or April, sorry. But if I were to come out here and do this interest payment, you'll notice that my interest would have gone way up. I would have been taking 1% now of this new loan balance. Remember, it was back at 0. In fact, we should have, when we paid that 10,600 off, we should have probably come down here and shown that. That was a February payment. So we had a 0 loan balance. And now if we're keeping track of our loan balance, we just upped it by 35,706, and we would pay the interest for that in the next month. That's what a line of credit allows you to do. So if somebody asked you what was the loan balance on March 1st or March 31st, I was going to say April 1st, what's the loan balance if we were to carry this schedule going out another month? Your answer would be, hey, well, we owe 35,706 and we would have to pay interest on that. So let me get that in there. They didn't ask you to do this at the bottom, I don't think, on Connect, but you better keep track of the loan balance someplace. Otherwise, this is a continual process. It keeps moving forward. It's what we call a continuous budget. All companies are usually working at least 3 months out, many a year out, to project these shortfalls and to be able to manage them. So let me stop. That's probably a new concept for many of you, the concept of a line of credit. For for personal finances, not business, for personal finances, I have a line of credit on my house. I've told you I've been through a series of medical emergencies where I wasn't able to work for an extended period of time over 2 semesters. Had it not been for an emergency fund like this, where I could pull on the money if I needed it, it was a terrible experience anyways. It would have been twice as devastating had I needed to go bankrupt because I didn't have funds to keep the household going. So one of the reasons why home ownership is important, and I know these are things that all of you are probably struggling to afford in California, especially, it's crazy. But once you have a home, you can take a line of credit. So the reason I personally like the line of credit is it's available for me, but it costs me nothing if I'm not drawing on it. I don't have to draw on it. I use it as an emergency fund. If all of a sudden I get sick or I have this big, huge repair that needs to take place, I can take money from the line and then pay interest back on that until I can pay it off. And it's tax deductible interest as well. Questions on that?
I have a question, Professor.
Yep.
In your experience, for the line of credit, what's like the most common interest rate for that?
Gosh, right now it's dirt cheap right now. I think when I looked at my credit line, I have a small amount because I used it to do some backyard repairs here. I want to say it was 2.75% right now. So I wouldn't expect it to be more than 3 at the most.
Okay.
Yeah, and right now there's so much money that the government's trying to push into the economy that many banks are doing these lines for cheap to nothing. So now is a really good time to get a credit line. Now, when I say get a credit line, I'm not saying go out and spend that money because I'm not about that. I'm get a credit line, have that there just in case, and know that that's an emergency savings plan to draw money from if you need it. Or gosh, we've all had our cars break down. I'm not sure I would use home equity money for a car repair, but if you want to improve your house, maybe you want new windows or you want a new front yard, that would be a perfectly good way to go pull it from the line, dirt cheap, better than putting on your credit card and paying 17 or 18% right now, and then pay it off as you can. And I think it's a tool that I've learned how to use. I try and keep a zero balance. I do have a small balance. That's why I know what the interest rate is. That is, by the way, through Bank of America. But if you guys are interested, first of all, you got to get a house. But those of you that may have a house, ask your local bank and then check out credit union rates as well right now. Or you might tell your parents, hey, mom or dad, dirt interest rates are dirt cheap. I've never seen them lower. In fact, they can't really go any lower. Now would be a good time to use the equity for appropriate expenditures. What I see happening and what I saw happening to my parents is they would use that equity line to go on vacation or to go buy a car, right? And to go do this and to go do that. Well, then what happens is once the draw period's up 10 years later, all of a sudden it's like having another house payment. And I think everyone should have a goal to retire with as little debt as possible. Certainly not a mortgage. That's the other reason that makes California challenging to live in, is in order to be able to pay off that 30-year loan by the time you retire, that means that we need to be buying a house when we're in our low 30s. And you guys know how crazy expensive California housing is. So that's a whole nother conversation. But lines of credit, if they're used correctly, are good ways of managing emergencies. Okay, any questions on the problem? Let's go try another one. I think it's going to be very similar, just to make sure that we got it. Now that one, you might have needed a little bit of help. You may have needed someone to explain why something was done. But now that we've seen it done once, maybe this one will be a little bit easier for us. Once we do 2 or 3 of these, the light's going to go on and it's going to make a whole lot of sense. So this one says Foyert Corp requires a minimum. Okay, there's that debt covenant. It's not because someone in the company just decided, oh, we want to have 30,000. Most likely it is a debt promise that we made when we borrowed money. Loans taken to meet this requirement cost 1% a month, paid monthly. And again, same thing that happened last time. Any excess cash is used to repay loans at month end. The cash balance on October 1st is $30,000. This is like deja vu, back to the other problem. Same cash balance. And the company had an outstanding loan of 10. Okay, so we're going to have to pay interest. So what I just read is they have this credit line. Right now they have $30,000 in their cash account. They promised to keep $30,000 in the cash account. And they have right now a loan of $10,000 where they have to pay 1% of interest. So they give you forecasted cash receipts and they want us to do the same thing. So my hope in giving you a second one of these would be that all of a sudden, after doing one or two, you would get the hang of it. So we would start off with our beginning cash. And then once again, I'm going to add in my cash receipts. And I'm going to take out my cash disbursements. So just like our regular cash accounts, that's what our bank statement looks like basically. And that's, oh, I got to do my interest. Let's not forget that we have a loan. So interest on loan, 1%. And that's going to give me what your book will call preliminary cash balance. I'm going to write in a note, promise to keep at 30,000. That's just my note. And then here's where I'm going to do the, now that you've seen it one time, plus or minus loan draws or payments. And that's going to give us our ending cash balance. So I'm going to stop. I'm going to put my 3 months across the top unless you guys have any questions. So my 3 months on this one are October, November, December. As soon as I put some dollar values in here, these columns will probably widen. I'm going to go fill in the cash receipts and the cash disbursements because those are easy. They were given to us. So here's my cash receipts. And then we'll do the cash disbursements. I'm going to put them in negative numbers so I don't screw up the math. That helps me visually. I have no idea whether Connect is going to have you do them negatively or positively. It really doesn't matter. For me, it's more of a visual. So I can see the money going out. So that's what I've done so far. I filled in my template with what I know. Someplace off to the right or the left, let's keep a balance in our loan payable account so we always know how much is due on it. You can do it in a note. You can do it through a T account. Doesn't matter, but keep track of it someplace. This time I think I'll use a T account just to show you alternative ways of keeping track. So here's a loan balance or line of credit. Payable, I'll call it. And I can't remember what the balance was. I want to say 10,000. Yes. So right now there is a $10,000 balance sitting in there. And so visually looking at that, I owe interest because the interest is paid at the start of the month. So I'm going to go ahead once I look at that loan and calculate that interest. 10,000 times 1% is what you want to do on your calculator. I think that's going to be $100, but I'll wait while we look. And I'm ready to run the numbers, which means I'll put that beginning balance in. And then it's just a matter of not messing up the math and making sure of two things. That we keep current on our loan payment, because by the way, if you don't keep current on that loan payment, that's another way to break the covenant, is to have an unpaid loan payment. And the other thing I got to make sure of is that my cash balance never drops below that minimum of 30,000 that debt covenant requires. So those are two main reasons why we're doing a cash balance. We don't want to make a promise. We don't want to break a promise that we've made to our bank or to anybody else for that matter. So I'm ready to run the numbers unless you guys have questions. And if you do, just unmute. Okay. Then let's see, our starting cash balance was right here, $30,000. I'll circle it so you can see it. That's going to be our starting point. So we started with 30,000. You guys can run the numbers with me. Let me put a line in there, a total line. And when I sum that up from top to bottom, or when Excel does it, I got 19,900. Okay, now I promised at all times that I would keep that number at 30,000. So in order to have that 30,000 in there, I'm going to have to draw on my line of credit. Okay, how much? Whatever it takes to bring me up to 30,000. So you can go ahead and calculate that if you want. 30,000 minus 19,900 is going to be the balance that I need to pull from my loan to meet that debt covenant. I got 10,100. I hope you guys did too. Let me write my formula so when you get home you can see it. 30,000 was my promise, and I have 19,900 now. So I'm going to pull 10,100, and while I'm at it, let's go add that to our loan balance. Loan draw to meet, what month are we in? October. Debt covenant. And might as well figure out what our line of credit is at now. I did owe 10,000. Now, after that draw, when I sum that up, I now owe 20,100. Okay, your interest costs are going to go up. And so why don't we go fill that in right now? Let's go put our interest payment in for the next month. So my loan balance is 20,100. My interest rate is 1% for the month. That would be 12% a year, by the way. They give it to you in a monthly rate, which is kind of weird. So 20,100 times 1% would be 201. That's going to be a minus. So I'm going to show it as a minus. And now I'm ready to run the numbers once I verify or answer any questions you have. Anything that you saw in there that you're not quite sure about, that you need explained again. This is a new concept, so it's normal to have questions. All right, let's run our numbers then. Our ending cash balance, when I take my preliminary balance and I add in that draw that we took from our line of credit, which bumped our loan up, I'm now at 30,000, and now I'm ready to run it. What do I mean by run it? That 30,000 rolls forward. And now we're in the month of November. We already put our loan payment in. So now it's a matter of just calculating either by Excel or by your calculator, running those new numbers. I got 34,799, but I'm going to wait. I made a promise to the bank that I would keep 30,000 in there at all times. I've met my promise. In fact, I have extra. So what we're going to do with that extra is we're going to pay down our loan. I gotta have 30,000. This goes back to Davi's question. She asked last time, I gotta have 30,000. That means I have $47.99 available to pay toward my loan because I gotta keep 30,000. So I have an excess cash here that I'm going to use to pay down my loan. So while we're on the topic of the loan, let's go put our T account in. Payments make our loan balance go down. So that was a payment on the loan. And so now I can refoot my T account. I don't owe as much as I did when I foot this. There's my new loan balance. So I still have to finish running the numbers here, but while we're on the topic, this is our loan balance. Again, I lost my month, November 30th. So while we're on it, we might as well go up here and do the December loan payment of 1%. So I'm going to go ahead and do that, and then I'll finish running the numbers. 15,301 times 1%. That was our loan balance that we just got from here. Let's go pop that in, and then we'll go back and finish running the numbers. All right, let's run it. It's no surprise because we used our excess cash to pay down our loan. It's no surprise when I foot this that I'm going to have 30,000. And so I will carry that up again. So here we go with another footing. And someone should have told me that you should put a minus sign in front of that. So to be consistent, right? So let me go put that minus sign in. As long as you do the math right, it doesn't matter whether it's plus or minus. It's just much easier in Excel to have numbers that are subtracted out as negative numbers. So let me go ahead and foot that. This is a flush month. So I'm going to stop. My hope was to have more than 30,000, and I do. So in the case of an excess, I'm going to take a look at that loan balance. When I compare it to my debt covenant of 30,000, I got about 19,000 something extra. But we're not going to pay the bank any more, not 1 penny more than what we owe. So I'm flush. I got about 19,000 to play with. I owe 15,301. So I'm going to go pay that off. My loan balance will be 0. And I would keep on going through a rolling budget. Okay, so let's put that in. I'm going to pay off the loan balance. And I'll go down here and show that just so you're keeping your T account up to date. And now my loan is nothing. So if we were to carry this out another month, I would have 0 interest payment. And now I just got to finish running the numbers. Let me put my total sign in there. Got a little bit of cleanup work to just sum these up. I will have more for the first time than what my debt covenant says I must have. I have 0 loan. That's a good position to be in when you don't owe anything and you have extra cash. That's a great position to be in. Most of us don't have that happen to us too often because we're, when I was in school, starving students when we're trying to put ourselves through college. Seems like well, I was, as a student, in debt to everybody, it seems like. But eventually, you'll get to the point where you're in those career jobs. I have students interviewing, getting all kinds of jobs. By the way, the starting amount at a Big 4 firm as of last week with a bachelor's degree in accounting, okay, not a master's yet, she has a bachelor's degree, was 67,000 with no experience at all. Just walk in, 67,000 on day one. And second person at a big 4 firm was almost within a couple $100, the same thing. That's when you can start, when you have that career job and your pay goes up every year and you're working really hard, that's when you guys can start paying down that student debt. And every penny you put into investing in yourselves, if you were in the student loan program, every penny is worth it. And I've seen so many students, including my own son-in-law, who got his master's at UCLA, who was scared to death about, oh my gosh, I have so much student debt. My daughter married him and was concerned about the student debt. They're both working professionals. They paid it off within a couple years. And that's what you guys will be doing. You don't have to pay the minimum. You can, once you get that money rolling in, get rid of that student debt, pay it off like this company was working hard to pay off their debt. And then it is freeing. It's a freeing feeling to be debt free once you get out of school. And every penny you invested in yourself will be worth it. Any questions on basic cash budgets? Any number you see up there, or any questions about debts or loan covenants? Okay, then 20-22. This one I threw in because letter C had a little bit of a difference in projecting out the cash payment. So we'll do this one. We do that last problem that we're doing is the toughest one. So I want to make sure that I leave time for that. Let's go ahead and do this one because it does have a new part to it. So this one says use the following information to prepare the September cash budget. They give us a bunch of information relating to cash receipts and cash payments. And our goal is to project out the ending cash. Okay, well, this one's a little bit different in that they give us, I don't know, 8 or 9 circumstances here. And if it makes cash go up, we'll add it. And if it makes cash go down, we'll deduct it. There will be a few curveballs in here. And so we always got to be careful when we're playing baseball, using a Dodger analogy. When we're playing baseball, occasionally there's going to come a pitch at us and we're not sure what to do. We don't take every pitch that comes at us. Sometimes they're going to throw you something that may not have anything to do with the problem. And I see one of those when I'm looking at this. So we'll have to be careful. Okay, so letter A says beginning cash balance. I think I'll just put a in red over here, a notation letter for each one of these. So let me go turn that red. And starting cash balance, we'll just label it that. Beginning cash balance. We are starting off with 40,000. Haven't seen anything yet in what I've read about any kind of debt covenant. So it could be that this is a company that doesn't have debt. Or if it does, it's a flat fixed amount and they'll give it to us that way. All right, letter B. They've spread out the cash receipts and they've just given it to us. We'll be working through a cash receipt problem here in a minute. They said cash receipts is 255,000. That makes our cash account go up, so I'll add that in. And here's a little curveball. They're going to time out some payments. So questions on A or B before we get a curveball. Okay, letter C. Raw materials are purchased on account. Purchase amounts are August. So they bought 80,000 in August. They're budgeting 110,000 for September. Okay, so we better be paying a lot of attention to what month we're doing. This is September. I'm going to write that above so we don't forget. We are specifically interested in the month of September. So they have some August purchases, some September purchases, and then there's a statement. Payments for direct materials are made as follows. 65% in the month of purchase and 35% in the month following the purchase. Okay, so we got two things going on. We have August purchases and we have September purchases. I'm going to list that. August purchases and September purchases. And I'll probably draw that out so we have a good idea of how those are being paid. So what that just said up here is that we have some purchases. And the way those get paid out is 65% in the month purchased. And the rest of it, the other 35%, would be the month after the purchase. Okay, little curveball, but that's okay. So if they had August purchases, if I look at this little flow chart, 65% of those would have been paid in August, last month. Remember, these are August purchases. We're interested in September. So we're interested in that 35% that would have been paid in September. So I'm going to write that down for your notes. $80,000 times the 35%. You might be saying, hey, what happened to the 65? It was paid last month in August. So all we're concerned about from the August purchases is the rest of it, this other 35%. And since this is a cost going out, I'm going to show it as a minus. So on my calculator, I'm doing minus 80,000 times 35%. I want that to show up as a minus. So from the August purchases that were made, the leftover amount, the 35%, I'm making in September. On the September purchases, that was the second part of this, they total 110,000. So I'm in September. Now I'm interested in what's being paid in the same month of September. Well, that's the 65%. So I'm going to do that on my calculator with a minus sign again. 110,000 times 65%. I got 71,500. So I split that out. I don't know if Connect does it all in one lump sum or how they do it. I'm splitting it out for your notes to make sense. Connect may combine those two, in which case you'd put whatever that sum added is. Okay, again, when you try these problems, you should be doing them on paper by hand first, and then use that Connect as an accuracy checker. That's the way we learn to logically use our critical thinking skills to work our way through these problems. All right, so I'm tired. That was a curveball. That took a little bit of practice. So letter D, wish I had my coffee up here. Budgeted cash payments for direct labor. Okay, so these are direct labor payments. We owe our employees when they're done working. We don't split that up. Can't do that legally. Got to pay our employees as soon as the pay period's up. So that'll be a straight 40,000. Here's a curveball. Letter E. Remember what we are doing. We are doing a cash budget. Moolah, dinero, dollars going out, cash. Depreciation is not a cash expense. I'm going to put an X through it. Depreciation is not a cash expense. I want you to think about that. When I bought this computer a couple years ago, that was a cash expense. When I went to Best Buy and I bought this computer, that was a cash expense. If this is a business computer, I'm going to do a third for depreciation. I'm taking the cost and I'm allocating it out over the asset's life. Depreciation expense is not the cost of that asset. That was paid for when you bought it. Depreciation is just splitting the cost out over the life. It's a non-cash expense. So I'm going to write that in your notes. Depreciation is a non-cash expense, And so I'm going to put an NA there, a not applicable. It's not a cash budget option. Now, if you were doing like a selling expense or a general and administrative expense, you would keep it on there, but it is a non-cash item. And so depreciation is never part of a cash budget, I think is what I would have you write in your notes. Depreciation is never part of a cash budget. The cash would have been expended when we bought the asset. So a couple of curveballs. One was a timing payment issue, and the other one was throwing you something that isn't even a cash expense. So, why did they put it in there? We're developing our critical thinking skills. They want you to weed through the noise and to use the relevant data. In fact, we're going to have a whole chapter coming up on relevant data, how to determine what's relevant. Questions? Okay, letter F, other cash expenses. Well, if they're cash expenses, they would cause our cash to go down. So let me put my minus 60,000 on that. Okay, accrued income taxes. When I see that word accrued, I think it's their attempt at a little curveball again, because accrued means something's owed, but then they clarify it. They said accrued income taxes payable in September. In other words, corporations pay taxes 4 times a year. One of those payments is due on September 30th. So they would have been accruing the income tax as they go. This is the actual money that's coming out of their account for September. So we will go ahead and include that. Income tax payment, 10,000. And then they do have some interest that they need to pay, some kind of loan interest. They didn't make us compute it. They just gave it to us, 1,000. And so I think I'm ready to run the numbers. Projected ending cash balance. You could do it on your calculator, but Excel is going to do it much more quickly and make a whole lot less mistakes than I would make entering those on my calculator. But I will wait for those of you that may be using a calculator. So the ending September balance is 84,500. Despite that being a tax month, that's pretty good. I'm looking at what they started at, 40,000, and what they ended at. And I think most of us in here would like a month like that. Questions? So 2 curveballs in here, just someplace in your notes. Sometimes we have to schedule out payments. You saw that happen with the purchases. And sometimes they'll give you irrelevant data that's not relevant to the problem. So in this case, they threw depreciation in there. For me, when I read this, I thought, gee, might be another curveball. I saw that word accrued and I'm thinking, no, I don't want accrued. I want cash. Well, then they said payable in September. That is cash. You guys are awfully quiet today. Any questions?